Welcome to the deep dive. You're here because, well, you're smart, right? You want to understand your options.
Exactly.
And today we're looking at LIC's new Jeevan Shanti plan. It's basically a way to pay once now.
And get income later. Yeah.
Precisely. Secure that future income. We'll break down what you really need to know. Keep it clear, efficient for you.
That's right. And at its core, it's what they call a deferred annuity.
Deferred annuity. Okay.
Yeah, you make a single payment up front, and then down the road, at a point you choose,
Right.
regular income starts coming your way. And it's pretty straightforward. It's non-linked, non-participating,
Meaning?
meaning your returns aren't tied to like market ups and downs, and there aren't any profit-sharing bonuses that change.
Okay, that's clear. So our mission today is to really unpack the main choices here.
Exactly. There are basically two main flavors to this plan.
All right, let's get into them. What's the first one?
Okay. Option one is a deferred annuity for a single life, just for you.
Single life.
Mhm.
Got it.
So you pick a waiting period, the deferment period, and after that's over, you start getting payments
For how long?
for as long as you live,
Yeah.
lifetime income.
Okay. And what about that waiting time, the deferment period you mentioned? Anything happen then?
Well, if you're alive, nothing's payable to you during that time.
Right.
But, and this is important, if you were to pass away during that waiting period,
Yes.
then a death benefit is paid out to your nominee. So there's that protection.
Okay, good to know. So deferment ends, payments start for life. What happens when the person eventually passes away after payments have started?
The annuity payments stop then, naturally. But there's still a death benefit payable to the nominee.
Ah, okay. So there's a death benefit potentially payable both during and after the deferment.
Exactly. Now, how much that death benefit is, it's calculated in a specific way.
How's that worked out?
It's basically the higher of two things. Either your original purchase price plus something called an accrued additional benefit minus any annuity you've already been paid out. Or simply 105% of your original purchase price, whichever of those is higher.
And that accrued additional benefit you mentioned, you said that builds up.
Yeah, that part only builds up during the deferment period. It's calculated monthly based on the purchase price and the annuity rate.
Yeah.
Think of it like a little bit of extra value being added each month while you wait for payments to start.
Right, a sort of growth component during the... Wait, makes sense. Okay, that covers option one. What was the second main choice?
Option two is a deferred annuity for joint life.
Joint life. So like for a couple.
It could be a spouse, yes, but also a sibling, or even, a parent or child, what they call lineal ascendants or descendants.
Interesting. And how does that change things?
The key difference is the payout continues as long as either of the two people covered is alive.
Oh, okay. So the income stream lasts potentially longer.
Potentially, yes. During the deferment period, same deal.
Yeah.
Nothing paid if you both survive. But the death benefit is only paid out after the last survivor passes away.
Right. That makes sense for a joint setup.
And then after deferment, the payments start and keep going as long as at least one of you is alive. Once the second person passes, the payments stop.
Yeah.
And then the death benefit goes to the nominee.
Provides security for both people then.
Good.
Let's talk practicalities. Who can get this? Age limits, investment amounts.
Sure. So you generally need to be between 30 and 79 years old to buy it.
Okay.
And the income itself, the vesting, can start anytime between age 31 and 80.
And the waiting period, how long can that be?
The deferment, it's flexible from just 1 year up to 12 years.
And minimum investment.
Usually it's 1.5 lakh rupees. Ours, 1,050,000. There's an exception though. It's lower, just ours 50,000. If the policy is specifically for the benefit of a dependent person with a disability.
Good detail. How about getting the payments out? Monthly, yearly?
You've got options: monthly, quarterly, half yearly, or annually. Each has a minimum payout, like ours, 1,000 a month minimum if you choose monthly. And interestingly, if you put in a higher purchase price, if you buy directly online, you actually get a slightly better annuity rate, about a 2% bump.
Oh, nice incentive. Is there a flip side? Like if you take payments more often?
Yes, there's a slight reduction. If you take it half yearly instead of annually, the rate's reduced by 2%. Quarterly, it's 3%, and monthly, 4% lower rate.
Okay, something to weigh up. What about the death benefit payout itself? Is it just a lump sum?
You can choose. Give you a lump sum, yes. Or the nominee could choose to annuitize it, basically turn the death benefit into their own income stream. Or they can take it in installments over 5, 10, or 15 years.
Flexibility there, too.
Yeah.
Okay. What if plans change? Can you get your money out early? Surrender.
Yes, the policy can be surrendered. You'd get back what's called the surrender value is the higher of a guaranteed surrender value or a special surrender value. The guaranteed value has a formula based on factors.
And loans, can you borrow against it?
You can. A loan facility is available usually after 3 months or after the initial free look period ends, whichever is later.
Does that apply during the deferment too?
Yes, both during and after the deferment period. There is a maximum loan amount, of course, and interest applies. They gave an example rate of 9.5% for 2020-21, compounding half yearly.
Right. Typical loan terms. Any other key bits we should mention quickly?
Well, there's the standard free look period, 15 or 30 days, depending on how you bought it,
Yeah.
where you can return it if you change your mind.
Standard practice.
Yep. And the usual suicide clause policy is void if it happens within 12 months, though they'd pay back 80% of premiums or the surrender value. Also, standard sections about no rebates and the rules around when an insurance company can contest a policy after a few years. Section 45 stuff.
Okay, pretty comprehensive look.
Yeah.
So, wrapping this deep dive up, what's the main takeaway for our listeners from all this?
I think you should now have a much clearer idea of how this new Jeevan Shanti works. You see the two core choices, single life, joint life, and how it aims to provide that guaranteed income down the line. It's about security.
Absolutely. You've got the foundation now to see if this kind of plan, paying once for future income, fits your own financial planning, whether for yourself or maybe for you and a family member.
And if it seems interesting, the next logical step is probably to, check out the LIC website or maybe talk to an advisor at a branch. Get the really specific numbers for your
Yeah,
situation.
definitely. Always about personal circumstances.
So maybe the final thought to leave people with is, what could that guaranteed income stream actually enable for you in the future? And thinking about that deferment period, 1 year, 5 years, 10 years, what timeline really aligns with your long-term goals?